One thing I'll touch on is premium finance as sort of infinite banking on steroids is true in the fact that your policy is doing two things. It's acting as collateral. We're able to borrow to do these things. While you have a policy loan, while you have a premium finance loan against that policy, you're not accessing the cash.
Correct.
But the cash is doing something for you because it's collateral for that loan
what
so
I
that
was
you can buy a lot more.
Yeah, what I was meaning is the money that you weren't paying that premium is freed up, which is it's like not infinite banking, but there's a version of it that's like instead of me paying $1 million, I'm servicing the interest, but now it's freeing me up to have this money to potentially do other things, and so it's indirectly
correct.
It's infinite banking in an indirect way.
Yes, so now it's doing three things, right? It's freeing up your capital so you can do other things. And you made a very good point there. Instead of paying the premium at a large number, we'll say $1 million, I'm servicing interest instead. The important thing is you could pay the premium. That's where it works well. Infinite banking works well. Yes. Full stop. Yeah. Premium finance works well when somebody can pay the premium but says this is a more efficient way for me to fund it because I've got opportunity cost to using my capital that I can go reinvest in my business. I know what my ROI is like. So that's where, and that's an important piece. So when you start to think about that, where does retirement income come into play? It doesn't. That's not the play. We're looking at estate planning, liquidity for estate planning. We're looking at a profile of person who can afford to strike the check, but is choosing not to because they can do other things with their money. They're not playing catch up on their retirement. And there are moving parts in premium finance that sophisticated buyers of premium finance understand. And it's been talked about on this channel. There's some really good points there on those moving parts. It's a sophisticated strategy that should not be pitched to the mainstream because when it's pitched out there to mainstream, they're not touching on those moving parts. You've got, let's assume we just use whole life premium finance. You've got dividend adjustments. They're not drastic every year, so it's like kind of mild, but we have guarantees. But then you have interest rate risks. And so what happens if interest rates go up? Well, eventually dividends will too. They'll kind of trail, blah, blah, blah. There's a couple moving parts there. A lot of times it's being shown with IUL. IUL is fine. It's complex. You got to make sure you understand. If you are buying an IUL and you don't understand cap rates, guaranteed cap rates, not just the cap, but the guarantee caps, what can they move it to? Do you understand participation rates, guaranteed participation rates? If what I just said is foreign to you and you own an IUL, get familiar with them so you understand those moving parts. Then you take those two moving parts, which affect crediting rates on the policy, and then you add in the variability of the financing. And now you've got multiple moving parts that work not in tandem together to benefit you necessarily. They could, but if they go the other direction, we're trying to outsource risk, but we just introduce risk.
That could be the line of the podcast is you started with talking about the importance of shifting risk. And there are people that are selling life insurance and buying life insurance where they're literally creating more risk.
They're creating risk.
They're creating more risk by buying life insurance. That should be the biggest red flag. And that ultimately should be like the question, does this shift risk away from me or does it create more risk?